starting a little bit later today. Had a meeting I couldn't move. I'm also in a different location because the internet is out at my house. There was somebody in my backyard installing like fiber optic cable, and it wasn't supposed to impact the internet, but I guess he hit something, and now I'm waiting for the cable company to come out and fix my internet. So I'm at my brother-in-law's house right now, different background, but same stuff. So let's get right into it. The latest Redfin housing data is what I'm going to be talking about today. We release this every Thursday, so I'm always going to be here live streaming every Thursday to tell you about it. And the big news is pretty similar to what we were seeing last week, but since it's the same trend, this is starting to look like a pattern. New listings have hit a 4-month high, while demand for homes has slipped. Now, the optimistic take on this is that buyers have more selection now than they have had in a long time, but they're not really biting at the chump to get these homes. They're sitting on the sidelines. And the reason why is because of high mortgage rates. The higher mortgage rates get, the less affordable it is to buy a home. So it's good for buyers that there is more selection of homes. But if we look over at Mortgage News Daily, we can see how mortgage rates have been increasing really since the start of the conflict in Iran. You can see this big spike in mortgage rates that happened right when we bombed Iran, and there have been some dips and valleys and such, but it's been pretty consistently increasing since then, which means that buying a home has consistently gotten less affordable. Now, if you have any questions, feel free to put them in the chat. I will be checking the chat throughout this live stream. Almighty Fushi says Dr. Daryl is so tough. Thank you. I'll just take the compliments. Feel free to put your compliments in the chat. I love compliments. They are my favorite. But yeah, let's get into more of these details. So let's look at what the big headline was, which is that new listings, they are up 6% from last year and up 0.4% over the last week alone. This big 6% gap is really reflective of the fact that this time last year, the housing market was different. There were fewer sellers and more buyers. So now there are more sellers and fewer buyers. But overall, the number of homes getting sold is down. Pending sales are down 3.1% from last year, and they are down 1.1% from last week. And this is all seasonally adjusted to take into account like normal changes in home sale trends over the year. But okay, so let's just take a step back for a second. What does this mean for the future of the housing market? When there are more sellers coming to the table, but fewer buyers coming to the table, prices have to come down. More supply, less demand. That's Econ 101, right? Prices are going to have to come down. So far, prices are still up from last year, 1.9% increase. I'm not sure why the week over week is not showing up here. But that's still lower than the pace of inflation. Inflation, depending on how you measure it, is about 2.5% to 3.5%. So in real terms, prices are already coming down, but this trend is probably going to keep continuing. I wouldn't be surprised if by the end of the year, prices are only up 1% or 0.5% or flat, maybe even 0.5% down. That would be pretty drastic if we went that far of a swing, but I don't think it's off the table at this point, considering the direction that we are headed in with more sellers coming on the market and fewer buyers coming to the market. And I talked a little bit about affordability. There was a time this year where median monthly mortgage payments, that's the mortgage payment for a median priced home based on prevailing mortgage rates. There was a while this year where it was down from last year, where things were getting more affordable for home buyers. But now that mortgage rates are back up, that is not true anymore. Now monthly mortgage payments are up 0.6% from last year. So it is now less affordable for a buyer to get a mortgage on the median priced home compared to where it was last year, which is different. It's new. And again, this is why fewer buyers are coming to the market, because it's gotten less affordable to them, and sellers are starting to come to the market. This mortgage rate lock-in effect, where sellers have been trying to avoid selling for the last 4 years because they know that mortgage rates are high and buyers aren't willing to pay high prices. Or if they bought a home during the pandemic, they weren't ready to sell yet, but now they're getting ready to sell. It's been 6 years since the start of the pandemic. 4 years since the end, depending on when you measure the end. So there is a cohort of people who bought during the pandemic. Maybe they bought a starter home, maybe they thought it was a starter home, but now they can't actually afford to move, or maybe they really want to move and they're starting to just say, the housing market's been like this for so long, I might as well sell. But because they're all kind of deciding to do this at the same time, there are more listings on the market, fewer buyers, prices are going to have to come down. All right, we have a question from Harut Abel. I'm sorry, I'm going to say your name wrong. I'm just going to say Harut over on LinkedIn, who says, do you think sellers are beginning to accept the new demand environment, or are most still anchored to previous valuations? That is a great question. And the way that I would answer that question is to look at asking prices. Asking prices are pretty much unchanged since last year. So I think at the very least, sellers aren't expecting like an increase in the value of their homes anymore. They are willing to accept that their home is the same value this year as it was last year, or at least they are in terms of their listed prices. They're not proposing these ridiculously high listing prices like they were last year, when the gap between asking prices and sale prices was actually positive. So right now, asking prices are actually below sale prices, which is new. It wasn't like this before. So I think that sellers are accepting this reality. They're starting to price more aggressively. And we've been hearing from our Redfin agents that the homes that are priced correctly and are move-in ready, they're still getting multiple offers. So even though I know I've painted a kind of dire portrait of what it's like for sellers, it's not uniform. There are still homes that will sell very quickly with multiple offers, especially if they are priced to move. It's those homes that just aren't that desirable. Maybe they're not in a desirable neighborhood. Maybe they have a weird layout. They're too small. They're too big. The insurance is too high. The HOA fees are too high. These are the kinds of homes that are going to be very difficult to sell unless sellers mark down the prices. And we've heard stories of that happening, especially in Houston, Texas. I mentioned a little bit about inflation being a cause of these higher mortgage rates. We had some new inflation data come out this week that showed that PCE price index increased by 0.2% in July, which is a reversal because in June it was down by 0.1%. And it also came in, above expectations. So more inflation pressure in this report, which is basically explains why mortgage rates are ticking up a bit. They're not coming down. Inflation is not getting better fast enough for mortgage rates to come down. But let's talk about some of those especially weak markets. So this is another report from Redfin. Actually, let me pause and just make sure I see if I have any questions. Oh, I got lots of questions on TikTok. Let's see. Is it better to rent and just put the extra money in an index fund than it is to buy? That's a question from Neil Gordon. Okay. If you put your money into an index fund in the stock market, historically, that gets a higher return than putting your money into real estate, into a home. Now, putting your money into the stock market, there's more volatility in the stock market. That's one of the reasons why the return is higher, because risk, when you take on more risk, you typically get higher returns. A home is inherently a safe asset because it's physical. You can live in it, you can rent it out. So even if the home isn't increasing in value as fast as a stock market portfolio, it has this other value to it, which is that you can live in it, you can rent it out, it's safe, it's like a physical thing that's always going to be there. It will never go all the way to zero the way that your stock portfolio could. I mean, it's very unlikely that the S&P 500 goes to zero, but there have been instances where it's dropped by 25%. That is very unlikely to happen to a home. And even if it did, you intrinsically still have value from living in your home. So I think, like, some people like to say, oh, you should just rent to put your money in index. I think it depends on your personal situation, how much risk you're willing to take on. And really what I think it comes down to in the rent versus own question is, how long do you intend to stay in the home? If you are going to be moving in the next 5 years, it is not worth it to buy for the most part, because you will be spending money on real estate fees, on transaction fees, on excise taxes. That's the tax that you pay when you sell a home, which makes it just not price out to buy a home versus rent it if you plan on moving. Now, the other benefit of owning is that no one can make you move if you don't want to move. If you're renting from somebody, your landlord can just say, your lease is up, I'm deciding to sell, or I'm going to do something else with the property, get out. So it depends on what you value. Do you value staying in your home a long time, really making it your own, personalizing it? Ownership is probably better. Or do you value flexibility? And that would mean that renting is better. You can also go to the New York Times. They have a great rent versus own calculator. It's an abstract exercise, though, to use those calculators, because they're going to ask you questions like, how much do you think rents are increasing in your area? How are you supposed to predict that? I can't even predict that. Or what do you think the return of the stock market is going to be, or your other options for investment? It's going to have these different places where you can put in different assumptions, and you can toggle those assumptions to kind of see how things might play out. But the truth is that nobody really has the answer. Right now, in the short term, it is more affordable to rent than it is to buy. Like, it's more affordable to rent a one-bedroom apartment than it is to buy a one-bedroom condo because of mortgage rates. But that is not sustainable. Over time, those things are going to converge. Rents are going to increase, or the price of those condos is going to come down until those things are equal. Because if they weren't equal, then people would stop buying and start renting, and then that increases the demand for rents, and then rents go up. So you kind of have to think about not just the affordability right now, but how much are rents increasing where you live, and how much do you think they're going to increase over time, and how upset would you be personally if they increased over time? These are all factors in that rent versus own. All right, what other questions do we have? What is your chess ELO? I don't know what that means. Feel free to let me know what that means. What's the best area in Texas to buy? Okay, let's talk about Texas a little bit. Okay, so we put out this report, Redfin did, about the Texas housing market. And the big takeaway is that Texas is the strongest buyer's market in the country. This is where the number of sellers far outnumbers the number of buyers. And because of that, buyers have a lot of negotiating power. When there are more sellers than buyers in the market, if one seller isn't working with you as a buyer, they're not willing to be reasonable, you can just ignore them and go to the next seller down the street. And that threat of walking away and going to another seller is what gives buyers the negotiating power to ask for lower prices or other concessions like inspection contingencies or getting cash at closing. That's the one that most people don't know to ask for, is that you can just ask the seller, I want $10,000 cash back at closing. Sometimes they'll say yes. There's some stories in here about real estate agents asking for that and getting a yes. So right now, Houston is the strongest buyer's market, followed by San Antonio, Austin, Dallas, and Fort Worth. In Houston, sellers outnumber buyers by nearly 130%. In San Antonio, it's 116. You can see in Fort Worth, it's 86%. But yeah, Houston is the strongest buyer's market. And one thing that's been coming up a lot in Houston is the cost of insurance. So there was a report that was put out by Rice University that found that insurance costs have been increasing faster than inflation. They found that between 2018 and 2022, which is actually before some of the big disasters happened, that insurance premiums increased 8.7%, far outpacing inflation. They also found that Texas is particularly impacted by these rising home insurance costs. That Texas has a higher risk because of climate-related disasters. In Harris County, which is where Houston is, 27.5% of housing is within FEMA management and floodplains. So in Houston in particular, these high insurance costs are really eating into affordability, because it's not just the mortgage payment that buyers are paying when they buy a home. They have to pay for insurance, property taxes. Property taxes have also been going up in Texas because Texas as a state gets more of its tax revenue from property taxes. It doesn't get them from income taxes, right? They don't have an income tax. So these increased costs are impacting buyer affordability in Texas, and particularly in Houston. Harut says, do you see Texas as a regional outlier, or could it be an early signal of where other Sunbelt housing markets are heading as inventory rises and affordability stays stretched? I think that Houston or Texas, I think at Texas, there's a lot of lessons to be learned about Texas. Now, I mentioned insurance being one factor that is eroding buyer affordability. But on the sales side, there are a lot of listings of homes in Texas because Texas builds a lot of homes. They make it very easy to build homes. They are just a great environment for builders. So there's all this new construction happening in Texas, and that also gives these buyers more options because if the existing homeowners don't want to sell, they can find a builder to just build a home and pay that way. So that also gives these buyers the ability to have better options. I think that that is a special thing about Texas that is so easy to build, but it shows or it demonstrates that if, for example, California became much easier to build in, they could expect prices to come down. They could expect buyers to have more negotiating power. You can see here that, apart from San Antonio, prices are growing slower in Texas than in the rest of the country. Not sure why San Antonio is an outlier here, considering that's such a strong buyer's market. But yeah, in Dallas and Fort Worth, prices are coming down. And I think, I mean, I think that like what we want in a place like California is for home prices to come down, or at least home prices to stop going up. So if California can learn from Texas and have an environment for building homes similar to Texas, then that would be good for the home buyers there. California also might look at Texas and how insurance premiums have been eroding into affordability for buyers there as well, and use that information however they may choose. Like, I think that as a government, what I would take away from the fact that insurance costs are going up is that we need to be doing more to make our neighborhoods resilient to disasters. Things that individuals can do. You can have insurance. You can harden your home to natural disasters, like have a new roof for rainfall or for hail, or do some shrubbery management. But it's really the cities, the communities that can take the big swings at protecting people and their homes from climate change. Because the cost of insurance, there's two things that go into the cost of insurance: the frequency of claims and the cost of those claims. There are steps that governments can take to reduce the frequency of claims, and that is to make their communities more resilient to climate change. Now, the cost of those claims, there's not much they can do about that because that's really inflation. I just showed you how inflation is up. When inflation goes up, that means that materials for rebuilding get more expensive. That means hiring laborers to rebuild homes gets more expensive. So there might not be much that governments can do about that, but they can potentially reduce the frequency of claims to get those insurance costs down. They can also regulate the insurance industry, but they don't want to over-regulate it to the point that the insurers pull out, which is something that has been happening in California and in Florida as well. All right, let me pop over and see what other questions I might have going on. What's the best area in Texas to buy? A place that has the potential to be the next big city. I have no idea. I don't know where I don't visit Texas enough to know like what the next big cities are. I can tell you what's happened historically. So let me just pop over here. During the pandemic, everybody was moving to Austin. People got priced out of Austin and they moved to San Antonio. So if you want to know like where the next place is that's going to go up in value, look at where people in the places that used to be affordable are moving to. I can actually go look at that. Let's look at San Antonio Redfin market, because we have some migration data. So I'm just going to on the fly answer this question, or at least try to. All right, where are people moving away from when they leave San Antonio? They go to Corpus Christi. So just based on, looking at this like data in the matter of minutes, my guess, if you maybe put me on the spot right now, would be that Corpus Christi would be a good place to buy, because when people are leaving San Antonio, that's where they're going. All right, let's see what else we got. Oh, okay. So another consequence of rising insurance costs, of home buyers having more and better options in terms of the homes that are available for sale, is that buyers are a little skittish to commitment. and buyers are canceling deals at the highest level in nearly 3 years. Now, I'm saying buyers are canceling the deals, but it really kind of takes two to tango here. Technically, once you make an offer on a home, or once a seller accepts an offer on a home, the seller cannot back out of that. The buyer is the one who is able to walk away. Now, if the buyer walks away before the inspection, if they don't have an inspection contingency, then they lose their earnest money, which is usually about 1% of the price of the home. So there is a consequence to the buyer backing away unless something comes up in the inspection. If something comes up in the inspection, they have an inspection contingency, and the buyer can walk away and not lose any money. And our Redfin agents have been saying that this has been happening more and more often. Something will come up in the inspection. Let's say it's a home in Florida, and the buyer finds out after they've made an offer that they can't get insurance on that home unless that home has a new roof. So it's kind of messed up, but the way that insurance works when you're buying a home is that you don't know how much your insurance is going to be when you make an offer on a home. If you're a go-getter, you might call up a bunch of insurance companies and get quotes ahead of time, but like almost nobody does this. People don't get quotes on insurance until they have already in the escrow period, until they already have submitted an offer and that offer has been accepted. So what's been happening is that people will find out, oh, wow, I didn't know that the insurance on this home was going to be this high, or I didn't know that I could only get insurance if I get a new roof or I do X, Y, and Z. So then they go to the seller and they say, I didn't know that this was going to be so expensive. Can you give me money? Can you pay for this repair? Can you pay for my new roof? Can you give me cash at closing? And because sellers are not in a great position, sometimes the sellers just say, fine, I don't want this deal to fall through. But sometimes the sellers get stubborn, which they have the right to be stubborn, right? Nobody likes being being like hassled for money when they weren't expecting that. Sometimes the sellers will say, go F yourself, walk away. And they won't say that literally, but they might say like, yeah, if you don't, I'm not giving you this money, go away, which can be really damaging, or I don't want to say damaging. It can be a tough experience to go through as a seller to put your home on the market, do a bunch of open houses, accept an offer. Home is off the market for weeks, and then the buyer walks away and you have to relist the home, and there is this kind of scarlet letter on the home that there was an offer accepted and the deal fell through. So now the next buyers are wondering what happened. And also there might be buyers who looked at your home and didn't want to bid or got outbid and they've already moved on to another home. It just introduces like a lot of pain in the process. So it's not great. It's not a good thing for sellers that these cancellations are happening. It is a sign that buyers are really in the driver's seat, that they're walking away from deals because they have, if the buyer walks away from a deal, they can just go make an offer on another home. It doesn't really impact them, especially if they didn't lose their earnest money. So this has been happening more and more. It's something that did not happen at all during the pandemic, because during the pandemic, it was strong sellers market, and sellers were dictating the terms. Buyers couldn't even ask for an inspection contingency without being laughed out of the room. So this is just a totally different dynamic than what we were seeing 5 years ago. All right, let's see. All right, well, I'll just take a moment here and say like whatever you're watching, wherever you are, hit that like button, double tap, subscribe, share this, whatever you got to do to help me out. I'm asking you right now, help me out. Like, subscribe, you know the drill. Comment, like, and share. Yes, yes, yes. All right, let's see. Any others? All right, well, let's keep it going, keep it moving. Okay, other big news. I talked about this a bit last week. There was this big sell-off of bonds in the market that was happening, especially for the longer duration bonds. I'll try to explain this as simply as possibly, but it's like bonds are one of those things that I think when you mention a bond, especially like a 30-year bond, people's eyes roll back in their head and they just stop paying attention. So let me try to really break this down. All right, last week, the investors got really nervous. They got nervous about the conflict in Iran and how long it was dragging on, how much it was costing. They got nervous about, these trade wars that are happening. They got nervous about the size of the deficit, and they just all kind of collectively woke up anxious. And when investors get anxious, they take their money out of whatever it is they haven't invested in, and they put it in safe places. Gold is safe. Bitcoin to some people is safe. I wouldn't consider Bitcoin safe, but some people consider Bitcoin safe because the quantity of Bitcoin in the world is capped. It's artificially capped, but it's capped the same way gold is capped. So a bunch of investors woke up last week and decided, I'm not feeling great about the United States. I'm going to pull my money out of US treasuries and put it into these safer assets. And what the Treasury did in response to this was, since people were selling these US bonds, they bought them to keep the prices of those bonds stable, essentially. And the way they did this was, they did some like financial magic where they sold debt bonds that were shorter term, like that would be paid back in the matter of like a couple of years, to buy the bonds that would be paid back over 30 years. It's called like yield curve manipulation. And this was widely criticized. This was Scott Bessent's plan. The plan, for the most part, didn't work. It didn't really do anything. I talked about that last week, how it was basically like shooting a water gun at a forest fire. And he's gotten a lot of flack from it. And he got a lot of flack from his former boss, Stanley Drunken Miller, who wrote this op-ed in the Wall Street Journal criticizing the move, saying that it was pointless, saying that like it looks bad, just kind of tearing it to pieces. Now what's kind of funny about all this, like this is a big news in and of itself, that Scott Bessent's how do you say that? Bessent's former boss, at least I think he's his former boss. Let me make sure I know who Stanley Drunken Miller is. Oops, I don't know what I did just there. He is the former mentor of Scott Bessent. I thought he was his boss, but he was his former. Oh, but they both worked for George Soros's fund. That's funny. It's just funny that the name comes up. Yeah, so he used to be his mentor, his boss, when they were both working at the Soros Fund, and he put out this op-ed criticizing him, which is like, in the world of finance, that's high drama. Your former mentor comes out and says you made a boneheaded move. That's drama. But there was more drama to this, which is that people read this piece and were like, hey, this reads a lot like AI. This sounds like AI writing. Volatility was contained and trading was orderly. Not a malfunction, but the machine doing its job. That's like classic AI phrasing. Not this, but that. With the M dash right there. And when people read this, they were like, this sounds like AI. People ran it through one of those AI detectors. It came back 100% AI written. And there was so much talk about this online that Drunken Miller came out and he copped up to it. He said, yeah, I used AI to write this. And then the Wall Street Journal editor came out and said, it's fine that this op-ed was AI written because the opinions in the piece represent the opinions of the author. And this is just like kind of opened up a Pandora's box of questions about like, is this okay? Are we okay with this? Are we okay with the Wall Street Journal opinion section printing AI written prose? Is that the standard that the Wall Street Journal should have? Is this a standard that other newspapers should have? Are we as readers okay with being fed AI slop, essentially? I mean, it's like, what is AI slop? Because probably what happened, and I don't know this for a fact, but probably what happened is that Drunken Miller gave his comms team maybe a bulleted list of arguments that he wanted to make. And normally the comms team, they would ghostwrite an op-ed for him. I'm assuming. I don't know for a fact. They might ghostwrite an op-ed for him. And that would be, human generated, but still not his literal words because it's being filtered through a comms department. But this time, what probably happened is that instead of the comms team taking that bulleted list and writing an op-ed by a writer, that comms team put it into Gemini or ChatGPT or Claude and had the AI tool do that work. And do we care? Should we care? For me, I think that this is this is icky. This is like icky, and it's unbecoming of the Wall Street Journal. But I understand that the Wall Street Journal is kind of in a tricky situation because they want op-eds from people like Drunken Miller who have these credentials, who have something salacious to say. I mean, this is like a very interesting piece, even taking apart the AI from it, just the fact that he stamped his name on a piece that was criticizing his former mentee and current sitting US treasurer, that is compelling in and of itself without looking at the quality of the writing or who did the writing. So I understand why the Wall Street Journal would want to publish it. I just feel like they should have maybe caught that it sounded like AI and suggested to Drunken Miller and his comms team to make some edits to improve the writing, because I think that copy pasted AI writing is bad writing, and you can smell it when you're reading it that something is not right. I feel like AI writing, it lacks a point of view in a way that human writing doesn't. And even if a ghostwriter is somewhat like diminishing the POV, I think the ghostwriter, at least they have some kind of human empathy to the person that they are ghostwriting for, where they can attempt to capture that POV in a way that artificial intelligence could not. So I understand that these important people use ghostwriters and it's an accepted practice, but I think that the ghostwriter does do a better job than the AI. And this guy, he's rich, he can hire a ghostwriter. He has the money. But by choosing to use AI, he's like taken away a job and created lower quality output. But, I'm not like here to dunk on people who use AI. I use AI, but I really am increasingly trying to be very careful about how I use it because I don't want it to diminish the quality of what I do. One of the reasons why I'm live streaming now is because I feel like live streaming is the most unfiltered way to present my opinions in an authentic manner. And the temptation to script something and then have AI edit that script, it's like it's hard to resist. But when you're live streaming, there's like no resistance that has to happen because I'm not using AI right now. I still use it to code. I think it's been great for coding. I actually love it for coding. It's amazing. I like almost wish that there wasn't any of this ability to generate written words or images, and it was really just a coding tool, because I feel like as a coding tool it is phenomenal and it's made my life easier, because coding, it's about logic, and then the logic is just translated into a language. And what the AI tools do is you can just give the AI the logic in any kind of language you want, and it'll translate it for you into the language of Python, of R, of whatever it is you're using. So I feel like I'm not at all ashamed to use AI tools for coding. I'll do that all day long, and I can just read the code output to validate it. But when it comes to writing, or even anything that I care about, really, in terms of the presentation, I think that it's being misused, and it's degrading the quality of what we get out there, and then we have all this slop. So that's my take on that. Let me see. Does anybody else have a take? Do you think it was it was right for the Wall Street Journal to publish an AI written op-ed? What do you think they should have done? Let me know in the chat. And also get my book, Hate the Game. Thank you. I really want to know podcast for pointing that out. I don't have it with me because I'm not in my house right now. You can just pretend I'm holding it up. Hate the Game, Economic Cheat Codes for Life, Love, and Work. It's not AI written. I wrote it. My editor was a human at the University of Chicago Press. I had a copy editor who was a human. It was human generated. And you can tell when you read it, like AI couldn't write what I wrote. AI doesn't know the inner workings of my mind well enough to say what I was saying. So if you want to really know my thoughts, go check out my book. You can really get to know me well. It's about how to use economics to advance your career and get the things you want out of life. And I use examples from my own life to demonstrate how I have used my PhD economics training to get what I want in my career and advance my career. So if you're somebody who wants to make more money, reach your career goals, live a better life, get the book, Hate the Game. All right, I Really Want to Know podcast says Claude AI has changed the game. Ghostwriters have a problem. I used Claude to help me edit a movie script into a micro comedy. I was very shocked how well it worked. Yeah, I mean, I think like, but the thing is that whenever I have AI write something for me, or even take something and condense it down or expand on it, I then have to go reread it with this lens, with a very critical lens. Because I think, like, as humans, sorry, I tapped that. I think as humans, we're just too accepting of words that are put in front of us as being truth. And what seems great on the first read, on the second read, you'll start to notice, hey, wait, that argument isn't well founded in facts. Or the AI made an assumption, if you're doing a script about a character and the way that character would act, that I never wrote in. It hallucinated this characteristic of one of my characters. So you almost have to, like, I think whatever I'm doing something with AI writing, I have to be very brutal with editing out all of the just fluff and crud that gets put in there. And it's like a different part of my brain that I now have to train to edit that stuff out. When I write, I tend to underwrite, and I think AI, and by underwrite I mean, like, I'll write 800 words for a piece on my first draft for a piece that will end up being like 1,200 words. AI does the opposite. It will overwrite something that should have been 1,200 words. It will write 1,500 words. And then in my brain, I'm like, because of the way my writing style works, I'm usually going in and adding in more detail. But when I'm working with AI generated text, I have to go in and take out a bunch of stuff, which I'm not used to doing. I'm worse at it than like my normal style of writing. So it becomes almost more difficult. So I'm really trying to rely less on that, except for corporate writing, because I hate doing corporate writing. It's the worst kind of writing, in my opinion. Like those emails that are like, I don't know, there's just like this way that that the corporate speak that people do that I am very bad at, and AI is very good at. So I'll use it for that, like taking an email that says, "Hey, what's up?" and turning it into, "Hello, I hope that your weekend was well. I am writing with," I don't know. I'm just trying to do the corporate speak. I'm not even good at it when I'm improvising. So that's why I think AI is being adopted a lot by corporations, because it really helps put all your writing into that weird corporate speak that everybody writes in corporations. All right, let's look over here. Lux F90 asks, how were home inspectors making money during COVID? Question mark. I mean, there were home inspections still happening during COVID. People just wore masks and did social distancing, and the inspections were happening, but they weren't being required very often because the sellers would not accept offers with home inspections. They'd rather take the cash offer with no contingencies or inspection requirements at all. All right, what other comments do we have over here? Christy Beach over on Instagram says, Redfin agent here. Can you make a video for us with this info to share with sellers? Such great info. Yes, Christy Beach. After these live streams, I clip them. Also, well, they automatically go on YouTube, so you can find it on YouTube. You're watching on Instagram, so I'm going to post it on Instagram too, the full unedited version. And then I'm going to make clips out of it too. And if you're looking for any of this data or any of these reports, they are all on Redfin News. Just Google Redfin News, and you can find the reports that I brought up and the data in our data center. But yeah. All right. What else? Oh, yeah. So back to this opinion piece. So what happened in markets is that investors were freaking out about the debt. And the reason that investors are freaking out about the debt is because the larger the debt gets, I have this little bag of money here with a bomb on it in the bottom red corner representing the debt, the higher inflation could go in the future. And the higher inflation goes, the less their money will be worth in the future, which means that they demand better returns on locking their money up in something like a 30-year US Treasury bond. So rates on US Treasury bonds went up last week. Besant tried to intervene to get them back down. It did not work, and he's being kind of ridiculed for that. But the broader thing that's happening in the market is that investors are getting really worried about our debt, about the breakdown in global trade, about disasters, putting us into this world in the red where we have low growth and high inflation. But what we also have in our economy right now is a lot of AI investment, especially in data centers. And all this investment in data centers is leading to more growth in the economy, kind of offsetting this decline in growth from the debt, but also it contributes to inflation because all this money is getting spent on limited resources for these data centers, limited labor supply, limited materials, limited, money just in general, and that drives up inflation. So investors in general are worried that we're kind of moving into this orangish red region of the world. And I have a YouTube video about this explaining this. It's called Where the Economy is Headed, if you want a more thorough explanation of what this chart means. But investors are getting more and more worried that we are moving into this type of world, kind of an orangish red world, where we have, pretty good economic growth because of AI, but very high risk of inflation, not just now, but 30 years from now is what investors were freaking about last week. When we have $40 trillion of US debt, how big is that debt going to get 30 years from now if it's already this big now? And that's why the yields, the returns that investors are demanding on these 30-year bonds went up. That's what Scott Bessent tried to address, and he failed. And I think you just have to accept that this is the world we're in. And the real way to address this problem is to lower the debt through less government spending and higher taxes, or to start cooperating with other countries so we don't have this breakdown in global economic cooperation, or to make investments in climate change mitigating technologies to reduce the risk of these natural disasters. Other ways they can address this is to do initiatives that get us more into this green region. I have AI here, but you can't get to like the actual AI without investing in data centers. So accelerating, the deployment of AI. Urbanism is another one, getting more economic output out of our cities by allowing more people to actually live in cities with higher density homes, having better public transit so people are able to afford to get around in their cities. Just designing our cities better, you can get a lot of economic growth and low inflation there. Nuclear, that's another one I have here, but really any kind of technology that lowers energy costs is going to pull us into a place where we have lower inflation and higher growth. And that's what the government should be focusing on. This kind of manipulation of markets, it's a band-aid on a bullet hole. And really what it does is that it tells markets that you're panicked. And if you're panicked, then they get even more worried about the state of the US economy and how bad things are going to get. So it's almost counterintuitive, but by Bessent trying to intervene in markets to get interest rates down, they went right back up because the market was like, why are you acting like this? Why are you freaking out? This is not how somebody in control acts, it was an unprecedented move. It was unprecedented for that kind of intervention in the markets to happen. All right. Oh, and I talked about the breakdown in tariffs. Oh yeah, somebody mentioned, I really want to know podcast says corporate writing and YouTube descriptions, LOL. Yeah, so I got caught last week with a mistake in one of my YouTube descriptions because my YouTube descriptions are AI generated because I didn't know people read them, to be honest. There's this whole world of writing that is AI writing to like words written by robots to be read by robots. And I consider YouTube descriptions to be words written for robots. What goes in the YouTube description is not really for the people watching the YouTube video. It's for the YouTube algorithm to understand what's in the video, to put chapters in the video automatically, and to know who to surface the video for. So YouTube descriptions is something that I have offloaded onto AI because I don't think people actually read it. But last week somebody did read it and caught a mistake, and I owned up to it being AI writing. But again, I'm not like ashamed of that. I feel like a YouTube description is not the same thing as a Wall Street Journal op-ed. So that's where I draw the line. Okay, anyway, back to the economy. So other big news this week is that the trade war is blowing up in terms of Canada-US relations, with the US um, putting tariffs on Canada and Canada retaliating, and we're not getting along, guys. I think that what Trump today put out an executive order that he was going to rename Lake Ontario to Lake America. Why not Lake Indiana? I feel like Lake Indiana would make more sense because you have Lake Michigan, and then Ontario borders Indiana. Well, not Indiana, Ohio. You could have called it Lake Ohio. I feel like Lake Ohio sounds better than Lake America. That's what I would have gone with, but America's bigger, better branding. But yeah, we're not getting along with Canada. I mean, I'm personally am fine with Canada, but our government is not getting along with Canada. And this is bad for the economy, right? Because this breakdown in global trade is going to lead to less economic output by both countries, which means lower economic growth and higher inflation because these tariffs are taxes. They make things more expensive. So, it just gives another reason for investors to be justifiably worried about where the economy is headed, that we are getting into trade wars with Canada. And all of these trade wars, it's showing up in prices. It's also showing up in building material costs. So the National Association of Home Builders, they did this survey of builders, and they found that the median builder has seen their prices for materials increase by 6.7% over the last year, which is about double the rate of inflation for everything else. So inflation seems to be hitting the builders particularly hard, which makes sense because they're impacted by these tariffs directly. And this makes it more expensive to build homes, which means that it pushes up the prices that builders have to set for the homes that they are building. And this means that there aren't as many homes getting built as there could be. I talked about how there are a lot of homes being built in Texas, but that's because it's so easy to build. And these builders, I mean, these material costs matter. They would be building more if the material costs were lower, and it also drives up the cost of insurance because these insurers, when there's a claim filed, they're paying for materials as well to rebuild those homes. So all this just adds the cost of buying a home, of owning a home, renovations. That's another thing that these material costs matter for. So it really is showing up almost like more in the housing industry than in other places, as exemplified by this chart. I really want to know podcast says our economy is not sustainable, is it? The average American can't afford America. Are we heading to a reset in the form of a recession or depression? I disagree. I mean, I don't know. I feel like things could get bad, but they're not that bad just yet. We are not even in a recession right now, let alone a depression. And one of the things about this whole debacle with bond yields is that they went up, but they didn't go up in an unjustifiable manner. The investors just looked at the size of the debt and how much that debt would increase in the future as that interest accumulates, and they demanded a reasonable price for it. It wasn't really a crisis that happened. So that's why what Scott Bessent did in doing this kind of emergency measure in the market was so strange, because it wasn't actually a crisis. So is our economy sustainable? I would say yes, because we've seen worse. It was worse in the 1970s and 80s with stagflation. I was just watching the movie Network the other day, and they were talking about, in the 70s, you had the Vietnam War, you had gas prices, you had, conflict in the Middle East like we had now, and you saw mortgage rates going up to like 16%. So it's not as bad now as it was in the 1970s. So I think that we should take that W. That even though when things get bad nowadays, they don't get as bad as they used to. You don't get the stagflation of the 70s. You don't get the Great Depression of the 30s. We are better at doing the economy nowadays than we used to be. But the challenges that lie ahead are big. We didn't have climate change in the 1970s, and that's something that's going to keep becoming a bigger and bigger problem. But I an optimist in terms of our ability to meet these challenges. I went to MIT for undergrad, and they were really techno optimists over there, and I think it seeped into my brain, or maybe I've always been like this, but I think that humans are just really, really good at solving problems, especially when those problems are right in front of their face. So, as bad as things could get, I feel like we're gonna band together and figure it out. At least I hope. That's the optimism in me. All right, what else did I want to talk about? Oh yeah, back to how things are bad though. I always talk about bad news, but I am an optimist. Um, Trump is proposing charging $100,000 for skilled worker visas, and this is like essentially a tariff on employment. If you're going to import workers from another country, you're going to have to pay this fee to do so. That's kind of like a tariff. And back to our little chart here, that means lower growth because companies can't hire all the skilled workers they would like to, or if they do hire them, they have to pay more for them. So that increases inflation. And it also impacts the housing market. There was this report from Bloomberg, Prashant Gopalan, Tanaz Meghani, shout out to Prashant, he's a great reporter, about how this H-1B crackdown that's already been ongoing, not even counting for this new fee that might go into effect, has already been reducing the number of Indian nationals coming to the United States to work. And it's led to an erosion in the Texas real estate boom. In Dallas, in particular, which you talked about, Dallas has a tech industry. They have like a lot of weapons manufacturing and I think like computer engineering there. They were hiring a lot of H-1B visa workers, and that was really fueling demand for homes in Dallas, especially newly constructed homes. But that's eroding, and that's why we're seeing fewer buyers relative to the number of sellers, and we're seeing a deterioration in home prices in Dallas. And that's what this Bloomberg article is about, how something like putting a fee on H-1B visas, it seems like it's just punishing international workers or punishing firms that hire these international workers, but it has knock-on consequences for the entire economy, including the housing market. All right, let's see what other questions we got. All right, yeah, feel free to, please like, subscribe, do the thing, do all the things, just reminding you, like, help me out. All right, let's see what other questions we got. I bought a house in Texas and it moved whenever the wind blew hard. I wonder how fast those winds were blowing. I wonder if it was a newly constructed home. There's all these reports about how quality of homes getting built is not what it used to be. I wonder how true that is though, because sometimes what happens is that people think older homes, or people think that homes used to be built better, of higher quality, but really they're not accounting for something economists call selection bias, which means that if a home was built in the 1915, let's say, and it's still standing today, that must have been a really well built home, because the homes that were not well built, they've already had issues, they've already had damage, they've already been torn down. So of course, homes, out of all the homes that were built, the ones that are still around for 100 years are going to be the homes that were built with the highest standards and quality. So it's not necessarily that they used to build homes better. It's just that the homes that were built a long time ago that were built shoddily are not around anymore. They've already been torn down. But the homes that were built during the pandemic, a lot of those homes were rushed because builders wanted to take advantage of all the demand that was happening. So they were like trying to rush as fast as possible to build them all. And now those builders are getting sued. So that's another story that's going on. All right. Any other questions? Oh, yes, it was new construction. Yeah, sorry. Is your home still under warranty? You might be able to get some money back. But that's unfortunate. Hopefully it's not. Hopefully it's just, moving in a sense, like it's just kind of swaying. Swaying is better than nothing. is better than, collapsing. All right, JT 1963 says, I moved to Florida and bought a house built in 1997. My house doesn't move whenever we have strong winds. Yeah, I mean, that might, I mean, if a home built in 1997 was swaying with high winds, then it might have already been knocked down. And so maybe your home was one of the lucky ones. Or maybe homes were built better in 1997. I always find it so interesting how like the quality of cars can vary so much from year to year, like even the same model and make, and how you got to look up like what are people saying about this particular year of this make and model of car in order to know if it's a lemon or not. I'm sure that the same principles apply to homes, that there are some years where the homes just were not built great and some years where the homes were built better. And it can vary from year to year. All right. Thanks to everybody commenting, especially all the compliments. I won't read all the compliments, but I see them and I appreciate them. All right, what else is going on? Okay, do I want to talk about, these are kind of like the bonus stuff. Well, I'm gonna probably wrap up soon in the next 4 minutes. So if you have any last minute questions, put them in the chat now. And instead of logging off before they actually like come to me, because there is a time delay, I will hang around and read them. And I'll talk about some of these bonus stories that I want to talk about. So one story that's out right now is this New York City is pied-à-terre tax. That's my attempt at saying French. Pied-à-terre, pied-à-terre. So New York City is putting a tax on second homes. I think, like in general, I'm not a huge fan of such specific taxes, because when you have a specific tax, like a second home tax, people can adjust their behavior. They can make their second home their primary home in order to avoid the tax, which people are trying to do. People who have second homes in New York are talking to their tax accountants and trying to figure out if they can claim that home as a primary home. But what's happening is that people who have a second home in New York and live in a place like Florida because they want to claim zero income state income tax from living in Florida, they can't simultaneously pay no state income tax by saying they're a Florida resident and say that their homes in New York are their primary homes, because if it's their primary home, then they should be paying New York income taxes, right? And New York, especially the city, has high income taxes or employment taxes. So this is like causing a bunch of rich people to freak out that they're going to get caught lying on their taxes. And they've been lying on their taxes for years. And because of this pied-à-terre tax, they now have to prove that their home is a primary home, but they can't because they've been living in a different state. They're stuck between a rock and a hard place. And it's like, well, why don't you just pay the extra taxes? You're clearly rich. If you have, a home in New York and a home in Florida, you're very rich. So just like suck it up and pay the taxes. But, people love dodging taxes, so they're upset about the pied-à-terre tax. And if they didn't like Mamdani to begin with, they have another reason to not like him. But I think I think this policy is a good policy because there are probably a good chunk of people who inherited a home in New York, or they bought a long time ago when values were lower, and maybe they got a fixed rate mortgage or they paid off their mortgage. So their carrying cost of keeping that home is very low, which is why they hang on to it, because who wouldn't just want like a bonus house in New York? That sounds awesome. But they don't value that home enough to pay the taxes on it, to pay these extra taxes on it. And if more people sell their second homes, like that's the real way to avoid paying these taxes, to sell that home, then those homes could be allocated, bought by people who have a much higher value for living in New York, people who work in New York and can't live anywhere else. Those are the people that should be living in these units instead of these second home units. Or if you want to have a second home in New York, like you're free to do so, but pay the tax. So I think that this is a good policy for New York in particular, which has a very limited land supply. They have very dense housing, and it could be denser, but it's just like the physical land of New York. It's limited, and there's so many people who want to live in New York that we should be encouraging these people who inherited a home, bought a home a long time ago, don't even live in it most of the year, to sell to somebody who is going to live in it most of the year. And those people, they're still free to come to New York whenever they want. They can still like rent an apartment and not have to pay this tax. They just can't sit on this asset and treat it like an asset instead of treating it like something that can bring value to a person's life. So I think it's a good move. All right, let's see what other questions we got. Yeah, share, like, do all the stuff. Like, share. Subscribe. All right. Well, I don't see any more questions, and I am at the mark for wrapping this up. So I'll just plug, if you already follow me on whatever platform you're watching this on, thank you. If you haven't, please click follow and go to another platform. I'm on all the social media platforms. If you're watching this on Instagram, follow me on Blue Sky or LinkedIn or Twitter, although I don't use Twitter that much anymore, or YouTube. Where else am I? I'm on Substack. Go follow me somewhere else. Wherever you consume whatever it is you consume, I'm there. I'm on Threads even. So go follow me on some other platform. I want to be a bigger presence in your life. I want to be where you are. Cue the Jackson 5 music. I want to be where you are. Okay, I'm not going to try to sing. Thank you. And buy my book, Hate the Game, Economic Cheat Codes for